Hi, this is James Shug with Westpac London's end of day report for Tuesday, October the 18th. The London market or European market trading today started off pretty bearishly, although by the end of the session, and it's now just gone 6:15 in the evening, sentiment had improved somewhat. I'll run through the fairly extensive list of events and comments and so on that were the key market drivers today. Started off in the Asian trading session with a little bit weaker than expected Chinese GDP growth. It came in at 9.1% annual, down from 9.5. Markets have been looking for 9.3. Some of the detail actually was okay on industrial production that we saw and investment, but nevertheless, the focus was on that weaker headline GDP number, which, as I say, was somewhat disappointing, given concerns that the Chinese economy might be slowing a little bit too much more than the policymakers might have been intending. We had a lot of ongoing comment from German politicians seeking, I think, to downplay expectations for the EU Leaders Summit this weekend. It starts on the 23rd of October. The commentary has been along the lines that we shouldn't expect a sovereign debt crisis solution to be laid out at that meeting. I get the sense, though, that during the day we did see a little bit of softening of that stance by the Germans. Angela Merkel was quoted as saying that there would be progress made, although another official who apparently has been involved in talks but didn't want to be quoted by name, he said that progress was going just millimetre by millimetre. So no real clarity there, but certainly a lot of comment for markets to absorb. A lot of concerns about France today. Moody's is doing its regular review of the French credit rating, currently AAA, but France is the weakest of all the AAAs in terms of its very high debt levels, and the spread between French and German bonds actually widened back to levels that we last saw around the time of the exchange rate mechanism crisis like 20 years ago. So there's still this ongoing concern about not just the lesser sovereigns in Europe, but even the credit ratings of the larger ones. We had the German ZEW analyst survey come out, which showed another fairly steep fall in the month of October. It's down something like, I think, 8 months in a row now. The expectations part of that survey is actually pretty much at the levels that it was running at during the recession of 2008-2009. The current index has also slipped. It's running about where it was just before the recession of 2008. So certainly en masse, German professional finance people, economists, analysts and so on, which is whose ZEW survey, the consensus among those analysts seems to be that the crisis that we're currently in poses as big a risk as we saw back in 2008 with the GFC Mark I, if you like. We had UK inflation figures, a sharp jump to 5.2%, the highest in, I think, 3 years. Not unexpected, given that utility bills did rise sharply this year, and the Bank of England, we're confident, will maintain that inflation is still going to fall quite sharply during 2012. I mean, after all, that's one of the reasons they felt comfortable firing up the quantitative easing asset purchase program again just a couple of weeks ago. Bank of America, decent result there in the continued sort of round of earnings reports that we're getting. Not so good from Goldman Sachs. They reported a loss, but overall, finance sector stocks in the US did particularly well today, with some of the banks like BOA making very decent gains, 7 or 8%. We had the National Association of Home Builders release its sentiment survey. It's an October number. It was the strongest it's been since the days of the home buyer tax credit back in the second quarter of last year. But at 18, up from 14, it's still way below the 50 neutral level and well down on the peak in 2005 of 72. So, it looks like it could be good news on housing, but in that context, that broader long-term context, housing still remains very, very weak. Still, on the back of decent jobs number in, less weak jobs number in September, and the retail sales figures we saw last week as well, there has been some better than expected US data of late, which has meant that we have revised up our forecast for third quarter US GDP growth, which is out next week, probably to closer to 2.25%, 2.5%. Compared to the 1.25% that we were expecting to see, and indeed which was recorded in the second quarter. In Greece, Papandreou, the Prime Minister, has just finished giving a speech to the Parliament there, where they're debating the next round of austerity measures. A lot of comments from him, but what stood out for me was that he acknowledged that Greece is struggling to avoid default. He certainly softened his tone a little bit from just a few weeks ago, where he insisted default was simply not an option. Maybe a bit of brinkmanship, maybe a bit of playing a bluff there, but nevertheless, it certainly is consistent with our view that it isn't going to be too long before Greece does need to at least see a substantial debt restructure, bigger than the 21% haircut that's the current proposed level of creditor participation in the deal that was brokered a couple of months ago. And just now, Ben Bernanke has given a speech, or has at least has released the text of a speech he's about to give in Boston. He doesn't discuss the current economic situation and monetary policy, but what he did say was that going forward, increased transparency and more guidance about the outlook is likely to come from the Fed, even when we're away from this situation of effectively zero interest rates. But as I say, no formal comment on the economy. And in fact, as that came through, we saw stocks in the US drift a little bit lower. Maybe there was some hope there that he'd say something a bit more supportive of further easing, but not to be. There's no Q&A following that speech, so I don't expect to see anything market moving more from that to come through. So they are the main events of today. Stocks in Europe opened down very weakly, down a couple of percent, depending on which market you look at. But at the close, the London market was down 0.5%, the French market down 0.8%, and the Germans actually managed to gain up around 1/3%. And as I'm speaking, the Dow in the US, actually it was up 0.75%. I think it's back at around a 0.6% gain at the moment. 11,480 odd is the level of the Dow. A bigger gain on the S&P 500, up just over 1%. We've got more results coming up. I think it's Apple and Intel we need to watch for over the next 24 hours or so. So a bit of a tech focus coming through there. In terms of commodity markets, we've got a 2.25% increase in the oil price. It's $88.32 a barrel. Sugar's up 0.4%, and the losers today, copper down 0.5%, gold down 1.2%. Gold's at $1,657 an ounce. The Aussie dollar up about a cent today at 1.0234, grinding higher through the European session into the US session, as the early losses on equity markets were lessened by this gradual improvement in sentiment, I think mostly related to the better than expected Bank of America result. That's about it for today. We've got a couple of things to watch for in Australia coming up. Westpac will put out the latest leading index, and Assistant Governor of the Reserve Bank, Guy Debelle, is speaking at a conference in the morning. Okay, that's it for the 18th. Back again tomorrow.